you talked about complexity a lot. So, 10 years ago, the knowledge of what drove capital, what drove your P&L, was pretty much diffused through the organisation. These days, it seems to be locked up now with a very small group of people, whether it be quants, CVA desks, etc., etc. So the amount of knowledge that used to be diffused across the organisation now is locked up with a small group of people. The second thing is that given all the problems that you're talking about in infrastructure, which actually I remember these conversations back in the 90s, so I don't think it's changed very much. Aren't we, given this knowledge base locked up in a small number of people, and given the complexity in the systems and how they need to run to get some of this information out, aren't we just moving down the track of really starting to look at increasing operational risk capital, which is something that really hasn't been addressed because the regulators have been concentrating on market and credit risk capital. But as soon as they get that under their belt, aren't they going to take comments such as yours and start moving down the operational risk capital area to cover the type of issues that you're talking about? Because I assume they're not going to be solved in the next couple of years.
Who would like to?
I'll start with a comment on that for me. Basically, yes, I agree with you that there is an increasing concentration in terms of expertise, but not just that, in terms of mandate for management within an organisation to a certain few. And I do see that as being a great danger. I mentioned the recent losses that are amongst the US prime name, as being part of that. Whether or not they were part of the diffuse organisation or a separate area, it occurred and the ball was dropped. It was also, looking at the model risk side of it, the fact that they had to change their VAR model sort of midway through this year to bring it back. So yes, there is, but it's necessary because regulatory capital is becoming increasingly constrained. A few years back, during the Basel I and Basel II days, people had capital headroom. Their business adjusted to it, but now capital is very expensive in a large number of ways. Suddenly, the assets you have on your balance sheet, the RWAs, the risk weightings that they actually attract, are going up. You're being forced to get more out of a much, much smaller pot. And during this transition period, it's not something that one can necessarily communicate to 10,000 people, or at the very least, sort of 800 to 1,000 people who are on a large trading floor. Even if you make it easy for them by having transfer pricing, so that you do it at the point of trade, you still have to communicate to them, this is true, very much. But the necessary management decisions about saying yes, go, no go, these diffuse areas, whether they be trading sort of a credit hybrid, whether they be trading a repo, etc., they're not in a position to see the whole portfolio and make a go, no go decision on the pricing and how to do it. That's why it's become centralized. But in terms of the ops risk, I would agree that, there is a view that if market risk is taken care of, credit risk is taken care of, counterparty risk is taken care of, what's left? Ops risk. And it is a bigger problem. It's refreshing to see what QandA there is amongst market practitioners and participations about exactly how difficult things are on a day-to-day basis to get data together, to worry about the siloing that went into the most market risk systems by separating asset class and then bringing them together on a fungible basis, whereas you do that for credit, you can't. Netting sets, aggregations mean that you can't. One PV is not the same as another. So this is a real problem. It's refreshing to sort of see that people are now openly stating that, because it's becoming a problem that's been too big to keep down behind your doors. The real issue is, how do you measure it and how do you put ops risk on the map for this? How do you quantify it? The lost data that's coming through is anonymous. One can't actually, if you do the key risk indicators, you'll find that the business heads themselves are putting the key risk indicators into the map and saying, oh yes, well if I drop this pen, who knows, the table could collapse, then that model could go down, we could lose billions. I mean, it gets from the ridiculous to sublime to the ridiculous in some senses. Until we can quantify that, and until there is a database of proper lost data cut across not just the regulated world, but also the unregulated world, we're not going to be able to map this. And I don't know if you agree or disagree with that, but it's a point of view.
I do agree with you, but I just feel that it's a place the regulators are going to go, and they don't necessarily.
They don't want to go.
they don't necessarily allocate capital based on risk management principles anymore. I think at the moment the idea is the political desire to stick as much capital inside banks as possible is where they're at. So you might just find that very simplistic ways of allocating, in other words, just increasing the percentages on the standardised approach could be as simple as they...
Well, they've got the fudge factors in there at 2.5% buffers. You know, they can raise them when they want to, and Osborne's fighting for us to be able to do that separately from Europe.
I'm sorry, I think there are other people. We will have some time after this Q&A, and I'm sure there is...
Sorry for the long response.
Yes.
Say it loudly. Thanks. Okay, maybe a question to Simon and Paul, maybe for him. Is there a difference, do you think, between hedging the CVA charge volatility and hedging the counterparty risk?
I'll try that. Well, it depends on if you're looking from an accounting point of view or whether you're looking from a capital point of view. They achieve different treatments, unfortunately. Certainly from an accounting point of view, people tend to actually report CVA volatility in a period, whereas there's a big debate going on at the moment. If we actually had to report the stock of CVA, then that would probably add billions in terms of the capital requirements of banks as it happens, as it goes forward. Volatility of CVA is a tricky issue. For example, it is not easy to be able to measure that directly, given the inputs that are involved. However, attempts have been made, and certainly at the operational level, Simon will probably say that, you know, we attempt to predict the CVA volatility largely by first order risks and also being able to make the prediction in the P&L, but on a long-term basis, which would affect capital modelling. I don't think people are there just yet to be able to manage that. So it's a good question from that point of view. I don't know quite whether that's what you meant in terms of your question, because I've answered it from two different directions. One, from the market perception of, you know, do we report volatility of CVA or absolute CVA, and if so, what effect will that have on capital? There is very big arguments going on between the accountants and the regulators currently about this sort of treatment alongside DVA and a large number of other issues, which is causing us problems in terms of being able to hedge on a long-term basis. Now, I could also sidestep the next one and flip it on to Simon to see what he has a view on in terms of his comments.
I'm not sure what to add to that, actually. I don't want to make up an answer. I'll pass on that one.
Maybe
I did.
Yeah, thanks. Well, I'm sure there are other questions. So
Well,
maybe
I'm happy to chat afterwards on that because it's an interesting question.
Yes.
So Paul alluded that collateralized risk should be managed together with uncollateralized risk. I would like to see from a practitioner point of view, from Simon and Andrew, what their view is on that topic and how practical that is.
Sure. It's difficult. You know, the collateralized risk, even with the very strong CSAs he's talking about here, you know, there's still gap risk. That gap risk, you know, we manage in the same desk but slightly separately. So it's done. You know, my boss, for example, is overseeing both. So there's one person and one business line seeing them, but it's managed separately. I mean, I don't think you can really manage as carefully as kind of like an exotic desk the gap risk on CSA. There's so many, the assumptions there are so tentative that it would be wrong to, every time there's a 30-year PRDC goes through the market and dollar-yen vol changes, to kind of suddenly re-hedge, I think, your gap risk assumptions. It may be just too short-dated a move. It mightn't last so long. You shouldn't react so quickly to that. There's so many assumptions that you shouldn't hedge too frequently, basically. On the gap risk.
Can I ask, if you've got a counterparty that has an ISDA netting agreement and a CSA, and then a securitization is done with that particular counterparty, which meant you have a number of trades in the portfolio with the same counterparty, the same legal entity, but it's outside of the CSA, how do you manage netting and aggregation there? Because closeout netting you can deal with it, it's just not under the CSA. But in terms of actual aggregation, you've got two separate paths there, and you're not, if you treat them separately, you're not taking any advantage of closeout netting whatsoever. How would you treat that in your organisation?
I think that's the tricky modelling question, to be honest. Within the model, to actually account for CSA by trade.
Yes, which you should do.
And
this is my point.
And I mean, I think I basically mostly work on the FX and rates and commodity side rather than actually the credit hedging.
Sure.
On the rate side, you know, the aggregation of those risks done properly within the model of CSA by trade still makes sense. On the credit side, you need to make some closeout assumptions.
No, I agree. I mean, it is complex, but you know, if you're looking about trying to maximise diversity from a portfolio, all risks should be there and managed. You may need a team of 20 or 30 people to do it and to break down the regular analysis of it, but it should basically put together. Otherwise, you're missing out on any form of diversification effects. This is my point, but it means that interest rate, FX and credit should be managed on the same desk, CSA and non-CSA together, to be able to drill into these particular problems, and only taken up in the EPE modelling of the particular counterparty. A CSA just simply reduces that EPE profile, okay, with some spikes for the 10-day market risk, but it still can be managed as an EPE profile and therefore can have a CVA and be aggregated normally.
Should I just add a few things from a modelling point of view? I mean, it adds a lot more complexity to the calculation, simply because you have to model that collateral position in some fashion. You also have to, you know, potentially worry about what are the different types of collateral you've actually got in there, and do you want to model the risk on the collateral as well, and model that simultaneously with the other elements in the portfolio. You've got to worry about the FX risk, and the, you know, FX moves over that period of whatever the cure period you're going to put in is. But there's a lot of assumptions there. You know, cure period 10 days, is that enough? Is it the right thing? So actually, you're very sensitive from a modelling perspective to all of those assumptions and that you put in there, and it's exacerbated with the CSA. Is it is it the right? So what it's going to give you is an amount of, you know, is what your gap risk is, but whether that's really a reflection on your gap risk is another issue.
Thank you for collective answer, and we still agree, I see, right, on everything, right? I think there was some question.
Yeah, I may have just touched on it just previously, but I was thinking about, given the sort of complexities here, how about sort of borrowing from synthetic loan securitization and actually securitizing the CVA portfolio and offering a first loss or junior mayors or whatever basis.
Fantastic. Who's the end buyer of that risk?
Yeah, I work in, well, I mean, I work on the buy side. I work on the buy side, and we've certainly taken exposure to sort of securitized loan portfolios. And
I've got 3 bank takers of your conversation. Thank you very much. How much of the portfolio would you like?
Sold.
Well, I mean, the issue we have is essentially that you've got obviously static versus dynamic exposures, and obviously there has to be a replenishment mechanism put in. And obviously, to make it attractive, someone like us, we need to have some kind of input in that, i.e., we just don't like the bank being able to stuff whatever they want into the portfolio.
But that's the classic CDO agent problem. I mean, you've got, the thing is that what you're talking about alludes to one of the real problems with what was meant to be the panacea, the world beater for hedging, and that was the CCDS. Yeah. The CCDS is meant to be a variable notional based upon an underlying that overcomes the block profiling of a normal CDS, which has a constant notional. This is okay if you're looking at a strict and static portfolio with no change to it, because you can then legally enshrine that and be able to monitor and manage that accordingly and be priced on that basis by a taker of this particular risk, whether it be on a first loss or a number of loss basis, second loss, etc. That can be done. The problem we have is that, you know, in all of our banks, with the counterparties we're trading with, there is no static portfolio unless it is a ring-fence loss, like the old monolines issue, for example, where it's a run pendant being run off and you wish to get it off of your balance sheet, or if it's a link to a securitization that is ring-fenced, and then you can actually take it off. But if it's securitized properly, why would you want to take it off anyway? Because you're taking the disintermediation out of it. What we find, and what we have found, and I don't know if you guys agree, is that the CCDS, even if it's becoming a standardized product, faces it's still an issue as a hedging product, simply because of that locking into an underlying derivative when we have constantly changing and moving portfolios within our counterparties. They trade swaps with us, or they don't trade swaps, or break transactions, or we decide to renew an ETO, for example, give you an extra profile risk, or we terminate when an ETO is given. So there's a lot more conversations to be had around it. It's a very bilateral and very proprietary. And I don't know if you guys want to.
Yeah, I mean, just to say, I think it will work. You know, it's something that's going to work on a small scale. But actually, perhaps if you've got part of your portfolio which is particularly isolated, it might, you know, that sort of thing will work reasonably well. But the complexity of dealing with the exchange, and it's if you're a big derivatives dealer, your portfolios with many of your clients will change on a daily basis. You know, if you're dealing with a lot of FX products, a lot of FX forwards hedging, you know, the turnover even on a corporate portfolio could be very significant. So it's how you deal with that is not clear.
Yeah. Oh, sorry.
No, go ahead.
Yeah, just a couple of points on it. I mean, I think you're right. We're all very interested in getting that risk off the books. I mean, just two problems generally is, I mean, as alluded to earlier, when you're pricing a deal, everyone, you know, just, and it's in relation to your point too, actually people are, it's not just us who, well, are supposedly know about this, really throughout the bank. Or, I mean, the average trader, the average manager is extremely strong pressure from senior management to really understand his returns, to understand what kind of funding costs, CVA costs he's adding to the bank. And it's the difference between winning or losing a deal right now. So these people are extremely aware, actually. I mean, maybe not, I don't know, 20 years ago, I'm not sure how aware throughout the bank they were, but now much more over the last 2 or 3 years. In terms of, though, actually doing the trade, simply because of this, I mean, really have to give sharp pricing to win the deal, or fair pricing, let's say. We don't have extra money. I mean, I don't have 3 times the CVA to pay JP Morgan the CCDS cost that they will charge me with the friction and rehedging costs and everything else that goes with it. Basically, CVA desks are doing an internal pricing, which again, you know, it's difficult to charge in too much bid offer. So we don't really have that extra money. Just the last point in terms of the first tranche, I mean, it's good. One of the tricky parts there is that we don't really have, the Paul might disagree, we don't have really correlation risk between our different counterparties. We own all the risk. Like if anyone defaults, we're in trouble. Yeah. Whereas doing a first tranche, or, you know, it introduces correlation risk, or maybe the first X million of losses or the first Y number of names, or both of them, it introduces some other risk that we actually don't have now. But still, I think it's worth doing, and I think there's worth us building the trust to do it, to replenish sensibly, because there's so much to do.
Thank you very much. We have time for one more question, and I see another.
Some very interesting points made by the panel. My question really is about the measurement and management of model risk. Does capital need to be held against model risk? Are there more effective ways to actually manage it? Do we want to look at, you know, actually setting conditions around model parameters, or perhaps what sort of trade should be done, or should we be sort of going through some type of reserve methodology? Just your thoughts on that, really.
I mean, clearly model risk is an issue. I think the regulator is moving quite quickly to ensure that, you know, there are reserves against model risk in all contexts, and focus on CVA and FEA models is obviously it's a big concentration of risk. You have one model effectively that is running a very large portion of the risk of the bank, and it is something that you need to address. And perhaps, you know, the first thing to do is to look at a reserve strategy. Part of that problem is understanding exactly what model risk you're running when you have such a complex model in place. Now you can look at stress testing, you could look at testing individual parts of the portfolio. That might give you a handle on the size of the model risk. It's very clear from my own institution that, you know, CVA from a modelling governance perspective is treated in a different way to the underlying models. Because of the concentration element, the bank recognises that this is a much more significant model risk and has ranked the model risk on this particular model much higher, and therefore there is a much bigger model governance oversight for the CVA and FEA models than there are for, you know, a single vanilla pricing, a single model. So that's how it is in our institution. Are we going to have to hold capital? Potentially, yes. It is another type of risk. But I think hopefully a reserving strategy and a sensible view will mitigate some of it in the first instance.
Okay, thank you very much. And let me again thank the panel. I think it will work as one. And each question, like you got 3 answers so for the same amount of money. So thank you very much, guys. Really great.